So my take
Yeah.
on since it's strictly the U.S. economy, my take on the market is really and truly, we are late in a recession. If you understand how the cycles work, then you understand that the U.S. market has actually been propped up by artificial liquidity provision since COVID-19. Since 2018, we really haven't seen a full market deleveraging. And as such, the market is very much expected to have some form of correction in the near future, probably within the next 4 quarters, etc. You should see valuation reverting back to the mean. But that being said, our speculation is just speculation. The Federal Reserve has made it clear that they are unwinding their balance sheet, which means that they won't be putting in much money more in the economy. They, even though cutting rates was driven by political pressure, the Fed has no incentive to continue to lower rates on these type of conditions because people are seeing where inflation is actually being resurfaced. The price of gold, where investors are positioning their portfolio, you can see that most investors are expecting some form of inflationary push. That being said, that's the side from the macroeconomic perspective, but from the market perspective, if you look at the S&P 500 has 34% of its valuation in a few equities, such as the Magnificent Seven, and that comes with systematic risk for investors. This is nothing new because this is just a general way of how the market has operated for the last 300 years when it comes down to innovation. I don't know if you know financial history that well, but if you look at back the railroad innovation, we saw where railroads once command over 30% of the general market. And the boom when DuPont was running the markets, with the invention of plastic and chemicals, you have those commanding up to towards of 34% of the market. In the AI boom, you had the same thing in the 2000, where technology stocks were commanding upward of 40 to 34% of the market on a relative basis. So the AI boom is nothing new. Yes, there's a lot of fraud in the market regarding AI because there hasn't been a profitable model as yet.
All right. But one thing I would say though, yeah, thanks for that, Ron. But just to rebut a bit of what you say, so as currently, as you mentioned about inflation, inflation is around 2.6%, if or somewhere there about, and the Fed target is around 2%. Now in May, when Donald Trump, when there is a time, I think in May there's supposed to be a new Fed chairman, and my estimation is that Donald Trump, the president, he will push someone who is more favorable in lowering the interest rate. Do you agree? And if such a person should come in to be the new chairman, I think would could that be a potential catalyst to basically push to inflate the stock market, and then probably can lead to more bubbles in the market, and then probably that can be lead to something of a more of a crash down the road, maybe a year or two. What do you think about that aspect?
So thank you. Yeah, so I read fairly today. I read an article where he's talking about installing a new federal chairman who is very much interested in handling the interest rate to a lower. So he's thinking about mortgage rates for his demographic of voters, etc. But one need to understand there's a general reason why the Federal Reserve has remained independent of the political environment or the president. And that's because when it comes down to macroeconomic conditions and in monetary policies, it's very imperative for the central bank to be separate from the government. And that because political leaders do have an incentive for a Goldilocks environment across the board. They want to see the environment, low interest rate, job stability, but that comes with the propensity of overheating of the economy. And that's a problem. Um, Currently, the last estimate for the US annual inflation rate was 2.7%, coming all the way from 6.5 with the COVID, that that was more of a demand pull based upon value chain bottlenecks and all that. But the average is normally 2% across the board for over a long time. But inflation is expected to rise currently based upon condition. A lower interest rate has the propensity of increasing valuation that are already overvalued and from a historical perspective. So that would draw a catalyst to an overvalued market and then a recession.
Yeah.
So
Okay.